Now, we also just heard from Fed Chair Jay Powell in D.C., and joining us from D.C. to discuss, Sheila Bair, the former chair of the FDIC and friend of the program. So, Sheila, what's your reaction to Jay Powell's remarks today?
Well, I haven't had a chance to review all of them. I was encouraged that Chairwoman Waters brought up Repo and encouraged him not to weaken the liquidity rules, which is good, and to end this gaming that we see with big banks doing at the end of year, where they try to use repo transactions to shrink their balance sheet. So those were positive, and he sounded responsive. The Volcker rule responses, I was just listening to those were disappointing. There's not really much left of the Volcker rule, and if they, finalize this last package of proposed changes, it's really not going to be any kind of an effective constraint anymore on prop trading at the banks who are in the safety net. So those are disappointing. The march to deregulation continues, and it sounds like I heard him earlier say that they're going to also be finalizing a package of rules which would weaken significantly the capital requirements. So these are disappointing trends.
Talk to us a little bit more about the repo operations. Is there, aside from that sort of end of year accounting, let's call it, on the part of the banks, is there anything else that concerns you about these ongoing repo operations? And do you think that the Fed indeed needs to start to wind them down, as it seems to have indicated it's going to do so?
Right. So, first of all, this is not caused by regulation. Regulation will always be a constraint. The big banks complaining that they're constrained to doing repo transactions, they're supposed to hold a certain amount of liquid assets. They're supposed to hold a certain amount of capital. These are rules that they're required to do. They're meant to be constraints. They need to manage above them. So to suggest that any rule changes are needed or that the rules cause this is not accurate. I do believe that there is a problem with the Fed draining reserves too quickly, particularly as we've had these massive debt issuances by our government. So the federal government has massive $1 trillion deficits. They have to fund those. That's taking cash out of the system. Draining reserves was taking cash out of the system, and so the Fed has now corrected that with these monthly T-bill purchases. So those are all positive things. I don't think we should have a standing repo facility. So when the large banks did not come in and provide liquidity to the repo markets, these short-term funding markets, the Fed came in with a temporary repo facility to do it itself. Vice Chair Quarles, I thought, suggested last week that maybe they could give them some breathing room on their intraday liquidity management, their intraday cash management, where they do prefer reserves. They don't want to release reserves because to rely on treasuries, those take a day to settle and reserves are immediately accessible. Right. So he suggested some minor modifications to internal stress, daily stress requirements that I think would address that problem without harming the integrity of the liquidity rules. So that actually, I think the Fed is responding quite well, and thank you, Jay Powell, for not, at least at this point, saying they're going to weaken the rules, because that's not what the problem is.
Hi, Sheila. Brian Chung here. So it seemed like the Community Reinvestment Act also attracted a lot of attention. Actually, it was the first question from the chair, that's Maxine Waters, of this committee. And what was interesting about the Community Reinvestment Act, for those that maybe got lost in the acronym CRA, is that the Federal Reserve is actually not on board with what the OCC, that's the Office of the Comptroller of the Currency, and the FDIC have issued in terms of reforming that rule, which concerns where banks actually lend to relative to where they take deposits from. I'm just wondering, you've been inside that regulatory system before. What is the significance of all the regulators not being on the same page?
Yeah, well, I think it's not good. Some of the capital rules, the weakening of the capital rules they proposed a few years ago, the FDIC was not on board. I hope they don't move forward. And now we've got the FDIC and the OCC lining up with the Fed, against the Fed, or different from the Fed, on CRA. So I think it's important that the bank regulators move together. If you don't have that, you start getting regulatory competition, and one regulator, to get charters is trying to weaken, and that's just not a place to go. We saw that with the now defunct Office of Thrift Supervision and the Office of the Comptroller of the Currency, prior to the crisis. So it's important that they move in lockstep and that they have good, strong rules to protect the safety of the system, both the financial integrity as well as the bank public obligations to provide broad access to banking services. So I think it's very detrimental. I hope they don't do it. It just sets a very bad precedent, CRA as well as the capital rules.
Sheila, I want to shift gears a little bit and turn to an op-ed that you wrote a couple of weeks ago in the Wall Street Journal called The Republican Case for Elizabeth Warren, in which you argue that she is perhaps not the far left-wing liberal that perhaps she is painted as being. Why do you think that portrayal of her has been successful, and why do you think that there is sort of a more moderate or conservative case to be made for her?
Right. Well, it is, mystifying because this Medicare for All issue was really what I think the media really started pushing her far to the left on it. And, she was trying to, I think aspirationally, I hope we all agree that, healthcare should be, it's a basic thing that people need. It should be accessible. It should be affordable. There are different ways to get there. But she actually tried to, present a real plan to implement it, whereas Sanders has just been, not saying much at all and gets a free ride. So I do think she's been under more scrutiny. We kind of saw the same dynamic with Hillary Clinton, where, people just really scrutinize and pounce. And I think there is a little bit of gender discrimination involved in it, that women are just still put under more of a magnifying glass. So I think that's unfortunate. Not all of her positions I'm comfortable with. I think she understands she's going to have a challenge in the general election. I think she can absolutely win a general election, explaining or convincing people who are skeptical on some of the proposals she has to really expand the government, both in healthcare and education. But, she's a practical person. She wants to get things done. And the difference between Elizabeth Warren and I think Bernie Sanders is she will fight hard to get what she can, but then she will take improvements, right? She's not going to be an ideologue and just say, my way or the highway. That's really not who she is. And she's delivered. I mean, the Consumer Financial Protection Bureau was her vision from start to finish. She pretty much took on the entire financial industry to get it done, but she did get it done. A lot of people helped in support of it, but it was really her leadership and vision. So I think she's got that track record, as well as understanding markets much better than Bernie Sanders ever thought about understanding them. I think probably more than any of the other candidates, say perhaps Michael Bloomberg. But that part of her is not coming out, which is why one of the reasons I wanted to write that piece, because I haven't endorsed her. I think there are a number of fine candidates, but I certainly would be happy to vote for her. And I do think there's a market-oriented side of her that's just not coming through with the media coverage.
Sheila, this is Emily McCormick. My question to you touches both on what you wrote about Elizabeth Warren trying to help society's most vulnerable and some of the questions that Jay Powell received today about wage growth and about just the anchors that have been on that, even as we have this increasingly tight labor market. So I'm wondering for you, and given your work, what do you really see as being the weight on the acceleration or the lack of acceleration we've seen in wage growth? And what do you think can be done on a policy side and from some of these candidates to help grow that?
Yeah. Well, I do think we've relied too much on monetary policy to drive our economy. It was low interest rates was really helped feed the housing bubble, and then we doubled down on it since then. So low interest rates basically inflate asset bubbles, especially financial assets, which are overwhelmingly owned by upper income people. And they also provide unsustainable growth by, encouraging borrowing. And they also prop up a lot of inefficient industries by, letting them stay alive longer than they should by this cheap borrowing. So these are the kinds of things that I think monetary policy it skews economic recovery, and we've seen this dynamic and why this recovery, so-called recovery, has not been broadly shared. It is finally trickling down. That's great. I think that was just more of a matter of time than anything Mr. Trump is doing, but he's president, so he gets to take credit for that. So we are finally seeing some better wage growth among low and lower middle income families, but it's not as much as we should. And then, of course, their wealth is below where it was even in 2000 because so many lost their homes during the crisis, and these stagnant wages have really impeded their ability to rebuild wealth. So I would stop relying on monetary policy. I would get more focused. Could we have an infrastructure bill that would create good, high-paying jobs that would make our economy more efficient, give us better infrastructure? It's a no-brainer. I don't understand why we can't get that done. We need to eliminate, the tax code is rigged. I don't like using the word corruption. I think that's a strong word, but it's definitely rigged. I mean, all the incentives are, so if you're an investor, you get lower rates on your capital gains, you lower rates on your dividends. If you sit on your wealth and wait for your heirs to inherit it, they get a stepped-up basis. Nobody ever pays tax on those capital gains.
Right.
So those are all things that reinforce and make the wealthy even wealthier. We're working people. We do have a regressive tax code, but we have a highly regressive payroll tax. And then with the shorter lifespans of lower-income people, they don't always enjoy the full benefits of the Social Security system they paid into. So these are the kinds of things I wish politicians would talk more about. And I think a lot of it just doesn't involve spending more money. It involves correcting the current government policies that skew wealth to higher income people.
Sheila, thanks so much. Good to talk to you. Sheila Bair, former chair of the FDIC.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.